In trading, leverage is everything. It's the engine behind both your profits and your risk. But what if your leverage can adapt in real time? What if it changed based on your trading volume, your account size, and even the market volatility? Well, that's where dynamic leverage comes in. It's a smarter, more flexible way to scale your trades without losing control. Now, in this video, we'll break down exactly how dynamic leverage works, why top traders use it, and how you can unlock its full potential. Okay, here we go. Fixed leverage versus dynamic leverage. It's the classic approach versus the cutting edge. Now, fixed leverage is the traditional method. It gives you a consistent static multiplier to amplify your trades. For example, with 1 to 100 fixed leverage, every dollar in your account allows you to control a $100 position. It's simple, it's predictable, and that's why it's been the industry standard for years. But the predictability is also its biggest weakness. Fixed leverage doesn't adapt. It ignores market volatility, trading conditions, or changes to your account balance. That lack of flexibility can leave you overexposed when the market becomes most dangerous. On the other hand, dynamic leverage is built for today's fast-paced markets. It automatically adjusts your leverage based on real-time variables, like your account equity, trade size, or current market volatility. In short, this adaptability ensures that you're trading with a level of leverage that aligns with your current circumstances, offering you a layer of protection while optimizing your strategy for various scenarios. Okay, so why is this important? Because trading is never static, and your leverage shouldn't be either. Using a system that evolves with your trading activity and responds to market behavior gives you a powerful edge. Now, dynamic leverage helps you manage risk more effectively while making darn sure your capital is working as efficiently as it possibly can. It's not just about protection, it's about performance. Now, dynamic leverage keeps you safer while you're chasing profitability. It adapts in real time so you're never trading blind. Dynamic leverage. Now, the term itself sounds difficult. It is anything but difficult. I'm going to show you exactly how it works over at Switch Markets right now, and it's going to take us probably under 2 minutes to figure this out. So remember, dynamic leverage is a safeguard. It makes sure and it helps you as a retail trader not get overextended with too large of a position size and too much of a per pip liability that can really cut in to your staying power, your ability to hold a position, your ability to trade multiple instruments, and also maybe just to ride out some sudden volatility. Okay, I'm going to show you exactly how it works right now. So dynamic leverage over at Switch, we're going to run through 2 examples here, and we're going to start with our Forex pairs. Now, this first example, US dollar, Japanese yen. Let's assume that you want to take 3 standard lots. Okay, now 3 standard lots with a unit size of 100,000 times 3 is going to be 300,000 divided by what? 1,000. That's your client account leverage. 1 to 1,000. 1,000 divided 300,000 divided by 1,000 is 300. That's the required margin. That means that you're going to have at least $300 in your account to service that position while it's open. Okay, that's just with a 3-lot position. Now take a look at example 2. Look at what happens now. You've got a 5 lots, okay? 5 lots means what? You've still got that 0.1 applicable margin. 5 lots times 100,000 divided by 1,000 means it's going to take $500 US now to carry that same position. 3 lots was 300, 5 lots is 500. As you can see, our required margin is getting bigger as our position sizes are getting bigger. Now, that is to do 2 things. Number 1, that's to make sure there's enough money in the account to service the open position. And number 2 is to make sure you don't get overextended. So think of dynamic leverage as a safeguard. Now, as you can see, we get up in the 45 and 50. You'll notice that the margin requirements increase, and what that does is that makes sure that you have to have more money to carry larger positions. The reason why, number 1, that protects the broker, and that also protects you. It's to make sure that you don't get over leveraged. Remember, theoretically, if you take a position in the market and you're over leveraged and it goes against you suddenly, you're on the hook for all those losses, all the losses you thought you were going to take, and then some. Dynamic leverage is there to help you out. So as you can see, as your position size gets bigger, your required margin is going to get bigger, and that limits really makes sure that you have the cash on hand to service the account. It's a safeguard. Think of dynamic leverage as your friend. It's a safeguard. So over at Switch, there's different margin requirements for your Forex, for your metals, for your cash indices, and your futures indices. The big thing to remember, dynamic leverage. As your position size goes up, your required margin is going to increase. That's going to limit really the positions that you could take with your allocated capital, and it's going to save your bacon if you get into a tough position. That's all there is to it, guys. Dynamic leverage is a smart way to maximize your chances of success in the markets. It helps you pursue profits without taking on unnecessary risk. And it does this by making sure you don't get overextended on any single position. Now, compared to traditional leverage, it offers more control, more flexibility, and ultimately more protection. Now, it's a modern tool for modern traders. Give dynamic leverage a shot and see if it fits your trading style. Now, if you found this video helpful, don't forget to like, subscribe, and hit the bell. You'll never miss another one. Thank you for watching, and we'll catch you on the next one.